Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar.
Good day, everyone. Welcome to another Cambridge Financial Podcast. Obviously, we've been doing these on a weekly basis, and we'll continue to do so for many, many years to come, because our number one goal is to provide you with a tremendous amount of information that you can take with you in order to better yourselves and your families from a financial standpoint. Today's topic is going to be a very interesting one, because it's one that a lot of people have a tendency to understand, but they also have a tendency not to do anything about. And that is the topic of the importance of disability insurance in a financial plan. So the importance of disability insurance in a financial plan is very, very comprehensive from a planning standpoint. Now, one of the major differences we do here at Cambridge compared to the majority of competitors that we have in the marketplace is that we look at financial behavior and financial planning from a risk management perspective. And what do I mean by this? Well, the majority of our clients, all of the clients that we engage, they all have four major risks that they need to deal with in their lifetime. And obviously, you may have many more of those, but the four primary risks that our clients are facing each and every day is the risk of dying too soon, the risk of living too long, the risk of living with a disability, and the risk of living with eroding factors like taxation, inflation, preponderance to consume, interest rate volatility, stock market volatility, and so on. Today we're going to be concentrating on the risk of living with a disability. And when you start to factor the risk of living with a disability, there are two sectors to it. One is the pre-retirement disability liabilities and potential risks that clients would have and Americans would face. And then the other one is post-retirement, where you have long-term care that comes into play and so forth. We're going to be sticking to pre-retirement disability because it is one of the most critical ones that we deal with in the marketplace. As we engage clients on a regular basis in reference to their finances, we notice that the majority of our clients do an okay to a decent job in protecting their assets. And, they buy life insurance to protect their lives. Now, most of the time, the amount of life insurance they purchase is not enough, because they've really never done any economic model calculations to determine what is the amount of life insurance that someone may need from a business and a family protection perspective. Now, in addition to that, obviously, you can get into the questions of not only how much do you need, but what type of insurance would you need, and also the type of policies that are available in the marketplace and so forth. And the same thing applies to disability, except that today we're going to deal with disability. Now, again, most of our clients do a fairly decent job in protecting their lives. They're good at protecting their assets. So they have strong homeowners insurance, automobile insurance. Many of them don't have umbrella policies, which I think are very, very critical, especially for clients that have a fairly high net worth. And that is one of the areas that we also help our clients in here at Cambridge. And so, again, most clients have a tendency, to protect the things that they own in case of theft or loss. And that could be any type of loss. A home, can burn down, and you obviously need to make certain that you're protected with that. Now, the other challenge that we have in dealing with risk management is that, most of our clients have a tendency to protect, all of their assets to 100% of their value, whether it's a home, cars, jewelry, personal property, whatever that may be. But when it comes to life, they do well short of what their asset value is. And when it comes to disability, the majority of clients that we engage, unless they happen to have some kind of a group disability benefit through work, the majority of them don't have disability coverage. And the one question that I want to ask all of you on this podcast is to figure out what is the biggest asset that you all have. Now, when I have that conversation with my clients, many of them would tell me that it is their home, it is their 401k, it may be their real estate properties and so forth. And all of those are good answers, but they're not the correct answer. The most important asset that all of us have is our ability to be able to wake up in the morning, go to work, or go to our businesses, and then earn a living so we can generate enough income and revenues in order to pay for everything that we own. And if at some point in time in our lives, we have a disability issue that we need to face, then all of those things are just going to go away, because if we don't have the ability to go out and generate income and or revenues to maintain our standard of living and that of our family, then we're going to find ourselves in a precarious situation from a business and financial perspective. Now, you would think that disability doesn't happen often, but it happens more often than you would imagine. So for instance, just to give you some data, just over 1 in 4 of today's 20-year-olds will become disabled before they retire. So that's at 25%, especially when you're that young, 20-year-olds. Now they have a tendency to do things that when you get to the age of 50, you're not going to be doing, but the disability, it's never going to go away, at least the disability risk. Now, over 37 million Americans are classified as disabled, and that's about 12% of the U.S. population. Now, more than 50% of those disabled Americans are still in their working years, so they're somewhere between the ages of 18 and 64. And that's a big number, because, many people would say, well, I don't see that many disabled people on the streets. Well, if you're disabled, you're probably not on the streets. Now we see people on wheelchairs and walkers and so forth, and they may have all types of disabilities, but maybe many disabled people are in hospitals, they're at home, they can barely walk, they have a very difficult time maintaining their health and so forth. So those are things that we need to be able to deal with. Now, in December of 2013, there were about 2.5 million disabled workers in their 20s, 30s, and 40s that were actually receiving Social Security disability income benefits. That's an enormous number from a liability standpoint. The probability of becoming disabled is much, much higher than your house burning down, or even you being involved in a really bad traffic accident and so forth. Now, the chances of becoming disabled are very, very high. So, for instance, a lot of things come into play when it comes to disability. So, if you happen to be a female, let's say age 35, you're 5'4", 125 pounds, obviously a non-smoker, who mostly works in an office job, and she may have some outdoor physical activities like working out or jogging or running or whatever it may be. There is a 24% chance of becoming disabled for 3 months or longer during her working career. One of the things that is interesting to note is that when it comes to the pricing of life insurance and disability, men have a tendency to have a higher cost per thousand for life insurance policies than women do. And the reason for that is women have a tendency to live longer than men, so they're going to be around longer. So a life insurance policy is not going to pay a death benefit until a later time. Now, when it comes to disability coverage, it's the opposite. Women have a tendency to pay a higher disability premium per thousand than men do, because women are more susceptible, although they're going to live a lot longer, they are more susceptible to sustaining disability that may keep them away from work for several months, sometimes, a year or two. Now, women also have a 38% chance of having a disability that would last at least 5 years. And that's important to note. Usually in today's marketplace, if you're seeking disability coverage, you can buy normally to age 65 disability coverage benefit. If you're going to work till age 70, you can buy until age 70 as well. Or you could buy as little as 5 years. And I'll talk a little bit about that in a minute. So obviously, the longer the disability period that you're going to be covered for, the higher the premium. Now, according to all the statistics, and this has been fairly consistent for the last 20 years, 92% of all disabilities are resolved within the first 5 years. So if you buy a disability policy and it only covers you for 5 years, or will provide a disability benefit for 5 years only, at least from a statistical standpoint, you're going to be covering 92% of all the disabilities that may hit you along the way. Now, there's that 8%. If you happen to be permanently disabled for life, then obviously that 8% potential is not going to be covered. But at the end of the day, you have to factor disability based on your pricing, based on your budget, and so forth. I would rather have a client that has a 5-year disability benefit than a client that carries no benefit whatsoever. Also, remember that if you had a machine sitting on top of your kitchen table that was generating whatever your income is annually today, whether it's $50,000, $100,000, $150,000 or $200,000, the one question I always ask my clients is, how much would you insure that machine for? And their answer is always the same. We would insure that machine for the amount of dollars that is kicking out every single day of the year. Well, what people don't realize is that machine is you. That machine is us. Again, our ability to wake up in the morning and go generate income in order to maintain our standard of living. Now, in this same scenario with a 35-year-old, 5'4", 125 pound female non-smoker, if this person were to use tobacco, so this person was a smoker, and instead of weighing 125 pounds, weighed 160 pounds, the risk of disability would increase from 24% to 41%. So that's almost double that sample right there. Now, if we're dealing with a typical male, same thing, age 35, 5'10", 170 pounds, a non-smoker, office work, just do some minor workout and so forth, there's a 21% probability of becoming disabled for at least 3 months or longer during their career. Now, if the same person used tobacco and weighed 210 pounds, then it goes from 38% to 45%. So those are things that need to be looked at. And obviously staying in shape and taking care of yourself and eating a well-balanced diet is going to help you not only from a health standpoint, but also from an energy standpoint. Now, samples that have a tendency to increase the risk of disability, excess body weight, if you happen to be a smoker, high-risk activities or behaviors, certain chronic conditions such as diabetes, high blood pressure, back pain, anxiety or depression. If you use quite a bit of alcohol consumption on a regular basis, that obviously can factor into that. And then obviously there are also factors that actually decrease the risk of disability. And those are, the opposite of what I just covered. So you want to maintain a healthy body weight, no tobacco use, healthy diet, some good sleeping habits, regular exercise, moderate, to no alcohol. Now, obviously, very few people can go without any alcohol, but you need to be moderate. You can be a social drinker and still be in very good shape. And then obviously you want to maintain a healthy stress for you from that perspective. Now, when it comes to disability coverage, most Americans will choose disability coverage through an employer-provided program. And there are benefits and there are issues and concerns when you have some kind of a group disability plan. If you happen to work for an employer and they do have employee benefits that they provide, and you're able to obtain group disability benefits, you will find that the premium is relatively low for the coverage that you require. Now, always remember that disability is not created to make you rich. Disability is created to make you whole. So if you're earning $100,000 a year and you become disabled, you want the disability policy to cover that for you. Now, when it comes to group benefits, the majority of the time the employer is the one that is paying the disability premium. Now, I have seen a number of employers that we do business with in which the employer and the employee share in the premium of coverage. And the reason why I mentioned this is that if the employer pays 100% of the premium or the cost of the benefit to you, if you do become disabled, then the disability benefit that you will be receiving from the insurance company will be taxable to you. If you happen to be in a plan where there is a 50-50 share between the employer and the employee, when you do become disabled, then 50% of that disability benefit will be taxable, and then the other 50% will not be. Now, one of the things that I encourage my clients to do is to consider individual disability policy. And one of the main reasons for that is because, Americans are changing jobs and careers all the time. The average is anywhere between 3 and 5 years. So if you change your employers, that group disability benefit that you have with your employer is not portable. So therefore, you're going to have to get some new disability along the way. If you own your own personal disability insurance contract, then it is portable because you own it, and everywhere you go, it will follow. Now, the other critical thing of disability, owning a personal disability insurance coverage, is that if you own it personally, therefore, you're more than likely going to be paying the premium yourself. And if you pay the premium yourself, then the disability benefits that you will receive at the point in time that you do qualify for disability, either due to an illness or due to an injury, then that benefit will be tax-free to you at a time where you want the least amount of expenses, or at least the least amount of tax exposure to you and your family. So that is one of the critical aspects of disability. The cost of disability varies. We use a number of different carriers depending on the type of work that the employee does. If you happen to be a physician, there are obviously many different ratings there depending on what it is that you do as a physician. If you happen to be an office worker, if you happen to be an attorney, the rates are differently, again, based on what you do. The same thing if you happen to be a blue-collar worker. There are companies that specialize in working with blue-collar workers because it's critical to understand what the rating is and what type of work they're actually doing. Now, do not confuse, please, disability with workers' compensation. Although they both accomplish the same thing, a workers' compensation claim is the type of claim that someone gets injured during the performance of their job. In disability coverage, it's a lot broader than that. So if you happen to be injured, or you have a heart attack, or you have a stroke, or you are all of a sudden you have certain other disabilities that will prevent you from working, then you will be covered under those premises along those lines. Now, disability coverages have different types of definitions. In own occupation is the one definition that covers the most. Obviously, it's more expensive because it basically says that you're deemed to be disabled as long as you cannot perform the duties of your occupation, even if you could do something else. So let's say that you happen to be a surgeon and you hurt your hands and you can no longer perform surgery, and you're generating $200,000 a year by performing surgeries. Now, if you happen to have the ability to go teach at a university and earn $200,000 just by being a professor, the own occupation definition will continue to pay disability benefits because you cannot perform the duties of your occupation as they were originally issued with the contract of disability that you purchased at the time that you were a surgeon. Other types of disability definitions will say that, as long as you cannot perform the duties of your occupation and or cannot perform the duties of other occupations, then you're deemed disabled. So in the same scenario I just gave you, if this surgeon is doing $200,000 in surgeries, and he or she can then go and teach at a university and earn the same $200,000, then obviously no disability benefit would be paid. But if the teaching, instead of paying $200,000, only pays $100,000, then if you have that residual benefit rider in your disability policy, then it will cover the difference between what you're earning today, which would be the $100,000, versus what you were earning as a surgeon. So it will cover the difference to make you whole. So again, there's a lot of planning that needs to be done along those lines, but it's important to understand, what actually it does to you and the benefits that are so important to have. If you become disabled, you can no longer make contributions to your 401k. So if you happen to be an employee and you're setting money aside for retirement, not only are you disabled now for as many months or years as you may be disabled, but you're now going into a really hardship situation because you're not going to be able to put money away for retirement as you would have otherwise. So those are things to consider along those lines. Now, there are over 2.8 million Social Security applications in 2012, and obviously it has been increasing. And disability, more and more disabilities are happening because of, musculoskeletal or connectivity tissue disorders and so forth. That's about close to 30%. Cancer is another major disability provider of illnesses, with about 15%. Injuries and poisoning, about 10%. Mental disorders, would be about 9%, and obviously cardiovascular disabilities represent about 8% of all disabilities. So the majority of the disabilities that we find are either mental or cancer or musculoskeletal from a disability cost perspective, and based on all the claims information that we get on an annual basis from the Council for Disability Awareness. Now, 1 in 8 workers will be disabled for 5 years or more. That's about 13% of the U.S. population. That's an enormous number. Now, most Americans estimate that their own chances of, experiencing a long-term disability are substantially lower than what they actually are, because we don't pay attention to it. It's never going to happen to us, and that's something that we need to be very, very cognizant of. What if you happen to be a business owner? And this is a question I ask every one of my business owners, and the question I ask is, can you afford to take a 6-month vacation? And they say, Bert, are you crazy? How can you ask me if I can afford to take a 6-month vacation? I can't even afford to take a week's vacation because I am the business. So my reply to that statement is, I appreciate you say that, but what if you have no choice? What if instead of having to take a 6-month vacation, it happens to be a 6-month disability? What if you have cancer and you have to go through chemo? What if you have a herniated disc and you need to have back surgery? What if you get hit by a car and now you're in a coma for 6 months or 3 months? What would happen if you have certain medical complications that require you to stop working? What's going to happen to your business? What's going to happen to the revenues? what's going to happen to your family well-being from that perspective. And the reason that I say this is that at the end of the day, it costs about 2% to cover disability benefits. So just to give you a simple example, if you're earning $100,000 a year, if you want individual disability coverage, if you're healthy, you're going to pay around $2,000 a year. So, you're going to set aside $2,000 a year, to protect $100,000 of income. I would do that every day of the week. Now, if I offer you a job and I have two propositions for you, and one is I'm going to pay you $100,000 a year, but if you do become disabled, then you're out of luck and you're not going to make a dime after that. What would you do? But then I come to you and I say, well, instead of paying you $100,000 a year, I'm going to pay you $98,000 a year. But if you do become disabled, I will continue to pay that $98,000 a year, either for the next 5 years, the next, age 65, age 70, whatever year that may be. Which one of those two jobs or those two salary schemes would you take? More than likely, and this is my experience with my clients, the majority of them are going to say, well, I'm going to take, the one that is going to pay me $98,000 a year, because I'm not going to have to worry that if I get hit by some crazy driver down the street, that I'm not going to have to worry about how am I going to pay my bills and protect my family and myself. Now, one of the most important things in disability coverage is that very few Americans are actually financially independent. As a matter of fact, less than 4% of Americans are financially independent when they hit retirement, let alone before they get to retirement. So the big question that you need to ask yourself is, well, how long could you afford to be without a paycheck? Now, whenever we put in disability plans for our clients, you have certain deductibles. You can have 30 days, you can have 90 days. You can have 6 months in which you have to be disabled for 30 days before the policy would kick in, or 91 days before the policy would kick in if you choose a 90-day elimination period. If you choose 180 days, which is 6 months, you have to be disabled for at least 180 days. So the big question is, how much do you have in savings in order to carry you through all those months that you're not going to be receiving disability benefit? If you don't have any savings, then I would choose 30 days. If you have plenty of savings, maybe you want to go 6 months and the premium would be lower. But questions that you need to ask yourselves is, how long could you afford to be without a paycheck? Do you save any of your annual income? 48% of U.S. families don't. Do you have any private pension coverage? Most of us don't. I mean, private pensions started going away, in the early 1980s. 68% of Americans would find it very difficult or somewhat difficult to meet their current financial obligations if their next paycheck were delayed for 1 week. I'm talking about almost 70% of Americans live paycheck by paycheck. Now, 65% of working Americans say that they could not cover normal living expenses even for a year if their employment income was lost. And 38% of them could not pay their bills for more than 3 months. So those are things that are very, very critical to understand. Now, most American workers' incomes are not protected, as I stated earlier. The majority of the clients that I engage do not have either umbrella policies or individual disability coverages. Now, there's about 100 million workers in the U.S. that are without private disability income insurance. And 69% of workers in the private sector have no private long-term care disability coverage. Now, it is the most important asset that all of us own, which is our ability to wake up in the morning and go earn a living. And most of us have a tendency to protect everything that we have, but we don't pay attention to protect our income or our ability to earn revenues from a business or employment perspective. Again, disability coverage as part of a well thought out economic plan is one of the most critical protection aspects that we all need to have, because you want to make certain that you protect yourself and your family against what can go wrong before you can start investing for what could go right. And like I always say it in every one of our podcasts, our number one job is to change the way our clients and our friends and listeners see things. Because when you change the way you see things, the things that you see change. I appreciate you joining us for this podcast. I want to wish you all the very best, and we'll see you again next week. And thank you for joining us.
Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement.